How to trade the wheel strategy for income was the topic of our monthly Zoom call this past month over at stockmarketoptionstrading.net and was presented by Brian Terry. Brian is an active options trader in retirement and gave us all his tips around trading the wheel strategy for income. To learn more about our monthly Zoom sessions, head over to the website and check the events section on the left. And if you're new to the channel and want to improve your options trading, consider subscribing and liking this video to let YouTube know you want to see more videos like this one. All right, let's get into the strategy.
Today's presentation is going to be on the wheel strategy and the poor man covered call. But before I start, just want to let you know that everything we talk about here is just for education. We're not making any trade recommendations or anything like that. So, and if you guys have questions throughout the thing, please just speak up. We definitely want to answer and make this as interactive as possible. The wheel strategy, there's a lot of people that trade the wheel strategy or some version of it. And it's an options trading strategy where you actually sell puts to collect premium. And if the stock price goes into your short put call, you will actually take assignment of the stock. And then once you take assignment of the stock, you would actually start selling calls as a covered call. So that's kind of and then once the calls get taken or the stock gets taken away, you start all over selling a new put on a new stock. So that's kind of the idea of the wheel. Starts with selling puts, you get the stock, you sell the covered calls, the stock gets taken away, and then you start all over again. So that's kind of why a lot of people refer to it as the wheel strategy. And I just wanted to give you a quick example of a wheel strategy. And I chose the SPY, and I at the time that I did it, the SPY was at 412 even. And so if we went out and sold, we would sell a naked put, or in some cases a put spread, and collect a premium. So I went to the option chain and looked at the 528 expiration, and we would have sold the 405 put. And in this case, we would have collected $281 per contract. And then based on my system, the buying power reduction or the margin would have been $7,545. So if SPY finished above 405 next Friday, you would have made $281 or about a 3.7% return in 10 days. And your break even would be 402.19. And all that is the 405 strike less the 281 premium that you took out. But the key thing on this strategy is if the stock finishes below 405, you'll be assigned 100 shares at your short strike. And in this case, that was 405 per share. And then you would need to sell calls against it to kind of complete the wheel. And the only exception is if you're doing this on a cash settled index, this wouldn't work. So you probably this strategy probably doesn't work really well for SPX or NDX. And I'm going to admit a few more people. Okay, so, and in terms of the benefits of the wheel, one is, and this is a very popular strategy, so it generates a lot of income by selling puts that expire worthless. That's kind of the whole idea. You sell the put, it expires, you start over. And if you get assigned, then you sell the calls. But the whole strategy is really just to generate income by selling the puts. And the strategy, and I've done a lot of research on the wheel. There's probably 100 different versions of the wheel out there. So your strategy can really be modified based on your risk tolerance, your, just whatever your preference is, you can modify this strategy. So the basic stuff is going to apply to everything. You may just want to change, things to better fit your style. And if you're on a margin account, you definitely will benefit by, reduced buying power reduction. So, for example, on Apple was trading at 124.85 at some point today. And if you sold the 528 120 put, you would collect $79 credit. And my system was showing me that the buying power reduction was $2,013 instead of the entire $12,485. So your rate of return based on the buying power reduction would have been, in this case, 3.9% in 10 days, as long as the stock finished above 120 by the expiration date. Your rate of return, you still would have made the $79, but your buying power would have been a lot less if it was a cash secured put. So any questions so far on any of this?
I had a quick question. So I was bringing up the option chain. So 528, are you usually looking at 7 to 10 days to expiration? Is that where you kind of?
That's generally the way I do it. I like to sell the weekly calls, but I've seen cases where people just sell the monthlies.
Yeah.
But what I found is that you can, if you sell every week, you generate a lot more income over that month period of time.
Right.
So, but that's more of a personal preference than anything that any rule or anything.
Right. Okay.
Mm-hmm.
That buying power reduction can grow, can it?
It can. It can change. It can change based on the fluctuation of the stock, and I would assume the volatility.
So you typically have a couple of these going at a time if you're buying 10 days out?
I try to, I'll go over how I do them in a little bit, but yeah, I try to add about one to two of these every trading day. So I will have, as many at the end of a week, 10 open positions. But that's just me. I mean, you could do it, based on your trading account size, how much time you have to watch them. You can kind of structure it any way you want to.
Brian?
Yeah.
It says here the buying power reduction of 2,000. Would you want to set aside additional capital that you kind of put on self-reserve? And if so, do you calculate that into your rate of return?
Yeah, I mean, that's a great question, because one of my points later is that you can really lose a lot more than that $2,000. Because if the stock really moves against you, that buying power you could lose more than that. So yeah, what I would say is you generally want to have some reserve set up, and we can talk about how to calculate that. But you want to be able to have enough cash that you could take 100 shares at $124.85, at least on a good portion of the put spreads the puts that you sell. Great question, though. That's really that's really important, because what you don't want to do is just write a bunch of these things, assuming that none of them are ever going to get assigned, because that's how people can end up getting themselves into trouble. So that is kind of the benefits of the strategy. And then I just wanted to show you what the risks of this strategy are, because you hear a lot of advertisement about this strategy and how easy it is and how it's free money. So I just wanted to kind of emphasize the risk as much as the benefits. So you can definitely be assigned shares of the stock if the stock moves against you. So you got to be prepared for that. Like Lee said, you got to have enough in reserves that you can take the shares and you don't have to exit out at a loss. And then the second point is you can lose more than the margin amount or the buying power reduction. So that's just kind of to your benefit. If it's a cash secured put, you can't lose more than that, because that's the entire amount. So that would be if the stock went to zero. There's also a chance that you could get an early assignment. So even though I said 5/28 was the expiration date, if it goes in the money, you could actually get assigned early. You could be assigned a day early, 2 days early. It just depends on when somebody wants to exercise their put. And then when you do take the stock, you are tying up your trading capital. So, say for example, that Apple trade, the stock dropped to $110 a share and you get assigned at 120. So you're already $10 underwater. And it may take you a long time to dig yourself out of that trade. So that's a risk involved in the trade. And this is really a bullish kind of market strategy. You wouldn't want to be putting this kind of a strategy on in a bear market, because you will get a lot of assignments and you just have to really watch that you don't get more assignments than you have capital for. And then the last part is you really just don't believe the hype that this is a free money or a guaranteed weekly paycheck strategy. Just hear that a lot. And I know, Lee, you shared a video with me. We talked about kind of the horror stories of, writing too many contracts on really volatile stocks where, you just get inundated with shares underwater and it just takes forever to get out of them. So just want to make sure we gave equal time to the risks of the strategy more than just the benefits. So, any questions so far or at this point?
Maybe you're going to cover this later on, but you kind of touched on it. So do you look at volatility, before you enter one of these, or what kind of filters do you use when you're making that decision?
It is a great question. I mean, volatility, the higher the volatility, it's kind of a two-edged sword. The higher the volatility, the better credit you're going to get for your naked put or put spread. However, there's a reason there's an increased volatility. So my advice would be, what you don't want is a stock that is super volatile, because then you're going to make sure, then you probably have a higher risk of being assigned the stock if it moves a lot. So I think, and then you want to have enough volatility that you get enough reward for your risk. So that answer your question, Patrick? Or whoever answered.
I guess I was asking if you have, say, a rule of thumb for that.
I don't. What I generally do is I'm looking at the stock itself, the stock chart, and where the support level is, and if it's in a bullish pattern, where would I sell my put so that it's below that level, and and then as I'm looking at maybe 2 or 3 different comparisons, the volatility change will really be reflected in the credit that you get there.
Okay, that makes sense. Thank you.
Mm-hmm.
Okay. You ever use the expected move, Brian?
I do. That's one of the ways you could do that. So, say for example, that stock is at $120 and the expected move is 10. Well, you could sell that put spread below that, 110 level. So, and it's a good way if you're looking at, multiple candidates, which one gives you the most downside protection for the same amount of credit.
Thanks.
Okay. Anything else?
So there are no stocks purchased against this, right?
Right. At this point, when you start, you're just selling either a naked put or a put spread. So you're not taking the stock on at that particular point.
Brian, do you have any advice for market correlation when doing your wheels?
Yeah, I mean, that's you definitely want to make sure that you aren't overexposed into any one particular sector. And I know when you talk to people, a lot of people, when they get in trouble, they were overexposed into a particular sector like technology. usually everybody is overexposed in technology because they pay the greatest credit. So you want to make sure, you know, you have some technology, but you also want to have financials, healthcare, you know, all the different sectors. And one of the things that I try to do is I look to see, you know, what sectors are kind of in favor, and then dig down in there and pick some stocks that, you know, might be good wheel strategies, or even the ETF, the index ETF as well. So yeah, you want to make sure that you're not buying all financials or all technical. You want a big mixture of either. You also want to make sure that you're not selling these puts through an earnings event, because that can really move the price of the stock. Or even big events, you know, like a lot of times companies will do presentations or new product releases and things like that. So you want to kind of avoid those. You want it to be as kind of with no news as possible. So when you are selling naked, sorry about that. When you are selling naked puts, you can decide how far or how close to the money you want to sell puts. So if somebody is a lot more risk tolerant, they may choose a higher delta, for example. But you could choose your strikes either based on a specific delta and say, I'm always going to sell the 15 delta or the 25 delta, whatever your kind of risk parameters are. Or like someone had asked earlier, you want to sell this strike somewhere beyond the expected move of the stock. So if the stock is going to move, say 10 points in this particular time frame, you want to sell something at least 10 points out of the money. And then you can also do it based on selling the strike either one or even two standard deviations away from where the stock is trading. So lots of different versions there. And what I would say is, if you're new to the wheel, you might want to test different ones and see which ones you're the most comfortable with. And then you can sell weeklies. You can sell monthlies. I prefer to sell weeklies, so I don't even hardly look at any stocks that don't offer weeklies. So I just eliminate them from my screening process. And then you can also sell this as a spread, and I'll kind of go into how I do that as well. So, but there are many strategies, many different ways that you can set up your wheel strategy. So kind of the process is you want to first focus on the underlying stock or ETF. You want to make sure that you're doing your analysis more on that than the actual options. And then you should have at least a neutral thesis of the stock. Hopefully it's a bullish thesis, but you could say, I don't think this stock is going to go down over the next period of time. And then once you've kind of selected a stock or a number of stocks, then you would go to the option chain to really see which ones pay the most credit. And what you'll find is that you'll find a great stock, and then you'll look at the option chain and it just doesn't pay anything for that risk. So you'll find some stocks pay better credit than other stocks, partly due to IV. Sometimes they just pay a higher credit for the risk. So again, you can look at the option chain either using a predetermined delta, say you always are going to trade the 25 delta, or you could look at, where is the support level, and you could sell your puts below that support level. Or you could select a strike, beyond the expected move, or just use one or two standard deviations. So that's kind of the most common ways of doing it. Does anybody else look at it at a different way of doing that? So I covered almost all the options. Okay. Okay, and then what I do is I sell wide put spreads. So in the case of just comparing, what I generally do is if it's a high price stock, say over 250, I generally sell like a 20-point wide spread. And what I found is that you collect about 80 to 90% of the credit of a naked put, and you have a lot more of a defined risk trade. So just doing a quick comparison on the SPY. So if we went back to our example and sold that 405 put, we would collect $281. The buying power reduction is $7,500, and the max risk, if it was a cash secured put, would be $40,000. So that return on the buying power reduction would be about 3.7% return. So you'd make $281. What I do is I would go in and sell the 405, buy the 385, and in this case, I would have collected $2.13 or $213 per contract. My buying power reduction and max risk are the same, $17.87, and my return would be about 12%. Now I'm getting less income. I'm making, the difference between 281 and 213. But if this stock, say it's sold off 10%, my max loss would be 1787. So that's kind of one of the reasons that I like to sell them as put spreads. One, it ties up less capital, but in the event of a trade that goes badly against us, I have a max loss that I can always just exit the trade and take that loss. I don't want to do that, but sometimes that happens, and you can exit the trade that way. So, any questions there so far? That makes sense, everybody?
Yeah. How do you select the strikes?
Well, what I try to do, I look at the expected move of the stock, and then I try to go beyond there, and I want to at least be one standard deviation move away from that, where the stock is currently trading. You just want to use a strike that's far enough out of the money that you have a really high probability of it not being assigned. And if it does get assigned, you're really getting that stock at a great price. That's the other thing. You want to make, like, for example, if, the stock, the index is trading for, say, I'm not sure what it was, 415, I'm willing to take the stock at 405. You have to have that kind of mindset to say, if it drops to my short put level, I'm willing to take it at that level and sell calls against it. That's kind of the whole kind of thesis of the wheel strategy. Did I answer your question?
Yep. In fact, that was what I had in mind. In the event that there is an assignment, how do you essentially avoid that assignment?
Yeah. I mean, kind of the whole idea of the strategy is, instead of getting stopped out or anything like that, the end result is that you're going to take the shares, and you're willing to sell covered calls against those shares until they get taken away again.
Hey, Brian, got a quick question. Do you time this with a broader, above the 50-day and below the 50-day, 21-day, any type of larger EMA to show that you're in a bullish stance?
Yeah, I mean, I generally want the stock to be above the 50-day EMA and above the 200-day.
Sure.
And in a bullish pattern, in some kind of a steady trend. You don't want a stock that's kind of bounces up and down. Those are not the kind of stocks you want to be trading this strategy on.
Were you doing this around the February 21st, 2020 transition?
Yeah, we actually did, and we took assignment on a lot of stock. We also got stopped out on a few, so that spread really helped, mitigate any major losses. And then we, definitely did a lot less volume of trades. So even this last 2 weeks, I've done a lot less new trades just because the market has been a little bit more skittish. So as the market tends to get either bearish or just unnerving, then I would probably not do this strategy. Or even go, further out. Say, you traded the 20 delta in a kind of a more volatile market. You may want to push back to a 10 delta or do a smaller size or things like that. So you definitely don't want to do this strategy in a bear market.
Sure. Do you, one final question, I don't want to dominate here.
Yeah.
Do you have a metric for your overall expectancy? Do you know what those numbers are?
Yeah, I mean, I bet, our assignment on these are very low. I probably get assigned maybe 10% of the time.
Right. Well, by expectancy, it's percentage per trade, what you generally know going into it for what you're risking. So I was just curious what you're generating in terms of your overall expectancy.
Yeah. Well, and keep in mind, I do them in a spread. So on a 20-point spread, I'm generally getting between 60 and 75 cents per contract.
Okay, great. No, it's great. As a point of reference, I'm a little over 50 cents, so I understand. So thank you.
Okay, good. And a lot of it just kind of comes down to how aggressive you want to be on your strike. And as I've kind of gone through this year, I've gotten less aggressive. So I'm pushing that down just because it's not worth it. You'd rather just kind of churn your puts and make money and than to take the stock, tie up capital, and write calls against them.
Very good. Thank you.
And so, some things to think about and I hope you can read this because mine's pretty small, but when you're doing this trade, when you're managing the trade, do you want to take, exit the trade early? Like say, for example, you collected $2 for your put spread and that credit is now down to say 50 cents, 25 cents. Do you want to get out early at a predetermined profit percentage? That's kind of a personal decision. Do you always want to hold them through expiration? It's kind of like I put it on, I leave it on and see how it goes. Do you ever roll the trade? And I personally, on my spreads, I will roll them out if I can collect additional credit. And then if this trade moves against you, do you have kind of a predetermined exit level? Say, for example, if the stock moves deep, how far into your short put before you say, I don't want to take it beyond this level? Or do you say, I'll take it no matter what? And then do you ever, like on my put spread, if the trade moves against my position quickly, a lot of times my long put will actually show a nice profit. And what I'll do there in some cases is close that out for a profit, and then I'll have a naked put. So, that's just something you should think about as you're building your strategy. Lots of questions and, lots of different ways of doing it. So if you, go on YouTube and you type in the wheel strategy, you'll probably get 20 different versions of the wheel strategy. So what I would kind of suggest is kind of take some of these points and build something that you're comfortable with that fits your trading style. And then just key takeaways. The wheel is a great strategy to generate income. And two, there are multiple versions of this trading strategy. So, what I do is what I call the wheel, and what Eric does or Lee does can be completely different. And there's no right or wrong version. And what I try to do is I have my version and I'm looking to see how other people trade it. So if there's a way, you know, like, oh, that's a cool feature, then I'll add that into my strategy. And I think too, it's important to know the risks of the trade, because I think a lot of people that are new to trading kind of hear that this wheel strategy is kind of an instant, cash card that you can just collect every week without any risk. So you just have to know what the risk is. And what I would suggest is build a trading plan or trading rules based on your own style, because the way I do it may not fit how you want to do it. And then the other one is, you need to be prepared to manage this trade, because it's not a set it and forget it trade, or at least in my way of looking at it is. If you have a setup that you said, I set it up, it expires, or I take the shares, then that's fine. But most people want to keep an eye on, see how the stock is doing, and see if they need to do any adjustments. So that is what I had for the wheel strategy. So any questions that I didn't already address?
One interesting twist I saw somebody else do on this is that they dollar cost average down on their CSP. So if they do get a sign, they might sell another one lower and another one lower.
Right. I've seen that. Yeah. So that's another strategy. I don't tend to want to do that usually, because if the stock dropped for a reason. So it's kind of like trying to mitigate your losses by buying more. And sometimes you can dollar cost average all the way down to the seller. But but there are people who do that. And I try to I'm a pretty conservative trader. Would you agree, Lee? And so I try to go as far out as I can so I can get a reasonable credit and then, generate the income without a lot of drama. So any other questions on the wheel strategy or the selling puts?
If you get assigned on this, where do you sell the covered call?
That's a great question. I generally sell it at the price I got assigned. So on that case where it was a 405, say maybe the stock got assigned at 405, but the stock's at 400. So I will sell the 405. And sometimes that doesn't work. If it drops too far, you just don't get any credit for selling the at the money call. So you have to be real careful and not be too aggressive in what calls you sell. But my goal is in this strategy is if I get the stock, I want to basically exit the trade as soon as possible.
Brian, is your ROI better on the call side or on the put side, do you think, and why?
Well, these are only on the put side. Usually my style is I'm just really trying to exit the trade at the assigned price. So I'm not trying to look to make a lot of money on selling the calls. So I can, I make probably most of the profit selling the put spreads before I get a sign. Did I answer that question with your question? I rarely kind of look at generating a lot of income from selling the calls. Anything you get is kind of a bonus. Okay. Any final
Why
questions?
is that? I mean, wouldn't it just be the same on the reverse side of it? You could just sell calls until you get assigned, or?
Well, you're already if you get the
until they get, yeah.
You can, but what your call, you're tying up, particularly, you're tying up, say, $25,000 in trading capital, and you're maybe making a little bit more in dollars, but return on capital is a lot less.
Right. Okay. Thank you.
Yeah. So I'd rather release that capital back and sell more put spreads.
Hey, Ryan, how about using margin to buy those stocks and then having a similar return on capital as the naked puts when you think about just buying.
Yeah, I mean, I don't trade on margin, so I'm probably not the person to try to answer that question. But I mean, ultimately, your risk is the whole stock amount kind of thing. So if you're on margin, your rate of return would be probably similar, but I personally would rather just free up my capital and have most of it in cash and be generating income off the put spreads. Okay.
Hey, Brian, would you have any guidelines as far as the underlying on market cap or open interest?
Yeah, I mean, you want to make sure that, kind of all the same rules apply. You want to make sure that it definitely has enough open interest, minimum of 100 contracts. You want to have a narrow, bid-ask spread. You don't want to be trading these on thinly traded wide bid-ask things. So, you look at the same kind of group of, stocks. There's probably 20 to 25 stocks or ETFs that I use for this strategy. So I don't go and try to find new ones all the time, but most of the time I trade the same ones over and over again. So, and if, you guys are probably on the Facebook group page where I post them, a lot of the same ones. Trade SPY all the time, trade the other index ETFs, and then the other big name, stocks that you wouldn't want to trade something you don't know or know about the stock.
Would you stay away from something like ARKK?
I would. I don't think that, Tesla, I was kidding Lee that every horror story about a stock involves Tesla. So I probably wouldn't do that. So you want to stay as, based on my kind of trading style, I would stick to more blue chip, kind of stocks.
Thank you, Brian.
Mm-hmm.
Yeah, I have a naked put in ARKG, so I don't know if that counts.
There you go.
It's right. It's teetering right at. I sold the 75 put, and I think it broke through 75, and now it's back above 76, 78 or something now. So I'm kind of just
that's the dilemma.
I sold farther out for that one.
Okay.
I think it was 30 days, so I still have. Or no, it was actually 45 days.
Okay.
But my plan was to, take assignment if I get it. But I felt like at the time I thought that it would just rally and I was going to take profits sooner, kind of thing.
Mm-hmm. Mm-hmm.
So now that we're in, correction or pullback or whatever, it's flirting with my strike. But I have time. I still got 30 more days. So if I hold through the correction, and it gets back up and I can get back out for 50% of the profit or whatever, I'll do that. But it is kind of
yeah, I mean, I think too, yeah, I mean, I think the market, how the market is going will also answer that question, Patrick. I mean, if it's a bull market and everything's good, I think something like that would probably be okay. But if it's more of a kind of a struggling market or a correction, you want to be, kind of really ratchet up your quality of your underlying. Okay. Any final questions on the?
Wait. Sorry. When you do SPY, how wide were the spread? You were doing 10 strikes.
20 wide generally. Mm-hmm.
Gotcha.
Yeah, and I generally will get somewhere between 60 to $1 for that spread.